Imagine a time when fortunes were made overnight, not in casinos or lotteries, but in the stock market, thanks to the internet. This was the dot-com bubble, a period of wild speculation and incredible wealth creation in the late 1990s. Companies with little more than a website and a catchy .com name saw their stock prices skyrocket. Investors, both seasoned and novice, rushed to get in on the action, fueled by the belief that the internet would change the world. And they were right, but the ride wouldn't be as smooth as they thought. This period was a time of unprecedented excitement and risk-taking. The internet, once a niche technology used primarily by academics and the military, was rapidly becoming mainstream. It promised to revolutionize the way we lived, worked, and interacted with each other. And for a brief, shining moment, it seemed like everyone could get rich from it too. In the early 1990s, the internet was still a mystery to most people. But behind the scenes, something big was brewing. The World Wide Web, invented in 1989, made the internet accessible to everyone. Suddenly, anyone could create a website and share information with the world. This sparked a frenzy of innovation. Entrepreneurs sensing opportunity flocked to create new businesses built entirely online. These dot-com companies promised to disrupt traditional industries like retail, media, and finance. Amazon, founded in 1994, sought to become the world's biggest bookstore without owning a single physical store. eBay, launched in 1995, created a global online marketplace for buying and selling practically anything. These pioneers, driven by a mix of vision and ambition, would become the poster children of the dot-com boom. Investors, eager to be part of this technological revolution, poured money into dot-com companies. Venture capitalists, traditionally cautious with their investments, lined up to fund the next big thing. The stock market became a casino, with investors betting on companies with little revenue, let alone profits. It didn't seem to matter. As long as a company had a .com in its name and a promising idea, its stock price would soar. Valuations reached astronomical levels, defying all traditional measures of worth. Companies were valued not on their current earnings but on their future potential, which, in the minds of many, was limitless. The Nasdaq Composite Index, heavily weighted towards technology stocks, became synonymous with the dot-com boom. It rose from under 1,000 points in 1995 to over 5,000 points in March 2000, creating a frenzy of speculation and wealth. Section 4. Faces of the boom from Bezos to everyday millionaires. The dot-com bubble created overnight millionaires and billionaires. Jeff Bezos, the founder of Amazon, saw his net worth skyrocket as Amazon's stock price soared. Other entrepreneurs, like the founders of Yahoo and eBay, became symbols of a new breed of tech-savvy business leaders. But it wasn't just the founders who got rich. Early employees of successful dot-com companies, often compensated with stock options, found themselves suddenly wealthy. Stories abounded of secretaries and security guards becoming millionaires overnight. The dot-com boom had created a new class of wealthy individuals, many of whom were young, tech-savvy, and eager to spend their newfound riches. Section 5. The warning signs, cracks in the foundation. However, not all was well in dot-com paradise. Beneath the surface of the boom, warning signs began to emerge. Many dot-com companies had flawed business models. They spent lavishly on advertising and marketing, often at the expense of developing profitable products and services. Competition was fierce, and many companies were burning through cash at an alarming rate. Some industry experts and analysts began to question the sustainability of the boom, warning that a correction was inevitable. But their voices were drowned out by the chorus of optimism and greed. Section 6. The bubble bursts, dream turns to dust. The inevitable crash came in early 2000. The Nasdaq Composite Index, which had peaked in March 2000, began a steep decline. Investors, realizing that many dot-com companies were overvalued and unsustainable, started selling their stocks. As stock prices plummeted, the panic set in. The dot-com bubble had burst. The consequences were swift and brutal. Many dot-com companies, unable to secure additional funding, went bankrupt. Thousands of employees lost their jobs, and investors saw their portfolios evaporate. The Nasdaq Composite Index lost over 75% of its value from its peak in March 2000 to its low in October 2002. The dot-com dream had turned into a nightmare. Section 7. Lessons learned, a reminder from the dot-com graveyard. The dot-com bubble was a period of extraordinary excess and speculation. It was a time when the rules of traditional investing were thrown out the window and the impossible seemed possible. But it was also a time of valuable lessons. The dot-com crash reminded us that even in the midst of a technological revolution, sound business fundamentals still matter. It showed us the dangers of speculation and the importance of due diligence. And it highlighted the cyclical nature of markets, reminding us that what goes up must eventually come down. The dot-com graveyard is littered with the remains of companies that promised to change the world but failed to deliver. But from the ashes of the bust rose a new generation of entrepreneurs and investors, chastened but not defeated. They learned from the mistakes of the past, building companies with sound business models and a focus